Welcome, everyone. We see attendees still logging in here, and we'll give it a couple more seconds. Okay, we'll go ahead and get started. Hi, everyone. I'm Jan Vega, Wealth Manager in our Los Angeles office, and I'm joined by my colleague, Laura Boucher, who is a manager in our Milwaukee office, John Allen, our Chief Investment Officer, and Marc Castellani, a Managing Director of our Investment Strategy and Research team. Before we get started, please know that our thoughts are with everyone who was affected by the devastation from the fires in the Los Angeles area. Jean Marc and I are here in our Los Angeles office, and we know how deeply these events have affected our community, including many of our clients and colleagues. Times like this remind us of the strength we find in supporting one another, so please don't hesitate to reach out to us if there's anything we can do to assist you. We also want to express our heartfelt gratitude to the firefighters and first responders who have worked tirelessly to protect our communities. Since our last investment outlook a few months ago, there have been significant developments influencing the markets. What's likely top of mind for most people is that we have a new president in office with new policies. The administration has issued numerous executive orders signaling a focus on pro-growth policies that aim to shape the economic landscape in the months and years ahead. While inflation has stayed stable, it has not yet met its target, and as announced yesterday, the Fed has put interest rates cuts on hold. Looking ahead, as John will explore shortly, companies such as Amazon, Alphabet, Microsoft, and Meta are ramping up investments in capital expenditures and R&D to position themselves at the forefront of the AI innovation. Investors are looking to see the potential for AI to boost worker productivity and enhance capital efficiency, which could drive long-term economic growth. At the same time, investor sentiment is shifting around AI chip manufacturers, especially NVIDIA, which faced a record $600 billion drop in market value this week. This came after DeepSeek, a Chinese-based AI platform, announced groundbreaking generative AI advancements. The evolution of this AI race will have far-reaching implications for productivity, corporate performance, and overall economic trends that we're monitoring closely. Finally, as Marc will discuss, the policy direction under Trump 2.0 will likely bring a mix of opportunities and challenges. Navigating this evolving landscape will require discipline and adaptability, especially as we anticipate more market volatility ahead. As John and Marc present, please feel free to use the dialog box on your screen to submit questions. We'll display the presentation slides, but you can also access all the slides on your screen. And the next day or two, you'll receive a recording of this webinar for replay at your convenience. With that, I'll turn it over to John to get us started.
Thanks, Jan. Hello, everyone. In addition to our thoughts and support for those impacted by the LA fires, we are also deeply heartbroken by the loss of the 67 passengers and crew members who died last night in the mid-air collision occurring over Reagan National Airport involving American Flight 5342 and a Sikorsky H-60 Blackhawk. Again, please don't hesitate to reach out to us if there's anything we can do to assist you and your families if you're coping with that immeasurable loss. Our thoughts are with everyone who's been impacted. Okay, turning to slide 4, most measures of economic activity suggest the U.S. economy is stable with modest GDP growth and strong employment while inflation is coming back under control, albeit at a higher rate than the Fed's target of 2%. The environment allowed the Fed to reduce rates by 50 basis points in September, followed by an additional 25 basis points in November, as well as another 25 in December. However, yesterday, as Jan mentioned, the Fed decided to hold its target rate at 4.5%. So it's maintaining its ability to stimulate by further reducing rates if the economy were to stumble in the future. However, equity valuations in the U.S. are stretched, implying continued excess increases likely based on expected productivity gains from advances in artificial intelligence. Currently, the market is expecting even higher growth rates for the U.S. over the next 10 years than we experienced over the past 10 years. Outside of the U.S., international markets present a mixed picture across countries, with Europe, Japan, and emerging countries generally coping with their own sets of issues and opportunities. In general, their economies currently aren't as strong as the U.S. but their equity valuations are more reasonable, especially for value stocks. Today, we'll re-examine different ways to construct investment portfolios, with each approach exhibiting trade-offs during different economic and market environments. To us, the most important thing is to choose a strategy and stick with it across economic and market cycles. Switching between strategies, especially doing so often, can really take an investor off course with respect to their financial planning goals. We think broad portfolio diversification is critical, since both companies and countries are in different phases of their economic and market cycles. Given where equities are currently priced, we expect to see some portfolio tailwinds coming from value stocks and non-US equities over the next decade versus what we have seen over the past decade. Turning to fixed income, core or investment grade bonds are generally priced to deliver better returns than they have over the past several years. Plus, bonds could offer more stability, acting as a ballast in portfolios if and as equities hit rough patches in the years ahead. Although not all portfolios hold diversifiers, for those that do, we expect them to continue offering enhanced diversification with exposures to long-short strategies, relative value, global macro, gold, to name a few. Slide 5 helps drive home the point about choosing and remaining committed to an investment strategy. The top chart will show the performance of 3 different portfolios over the past 24 years. While that's a long time, most investors' horizons exceed 40, 50, or even 60 years. The gray line displayed represents a traditional global balanced portfolio consisting of 60% equities and 40% fixed income, with the equities being weighted by the market capitalizations of their underlying stocks. As you can see, $1 million invested in a strategic or market cap weighted portfolio in January of 2000 grew to $3.72 million today. And that's a nice investment return and likely helped those investors achieve their long-term financial planning goals. The blue line presents another globally diversified 60/40 portfolio, but its equities are equally weighted by the number of stocks in the portfolio. As you can see, the equal weighted portfolio did a better job than the strategic portfolio, with every $1 million invested growing to $4.08 million over the period. So holding a more diversified set of equities and avoiding an overly concentrated portfolio added to the portfolio's returns. The third portfolio, the orange line, represents a composite of 6 actively managed portfolios in which the fund managers have the ability to change exposures to various global asset classes. Every $1 million invested in a composite of dynamic or valuation-driven portfolios grew to $4.46 million by December 2024. And importantly, the orange line represents live funds with actual track records after deducting their fees. The gray and blue lines are index returns and therefore don't deduct any fees. Our conclusion isn't that one of these strategies is better than the others. Rather, instead, we'd conclude that remaining fully invested in one strategy is the best course of action, and frequently switching strategies risks falling short. And that's because an investor would be likely compelled to switch into the strategy that had recently outperformed, but could very well underperform going forward. The bottom chart presents the performance of each of the portfolios over the past 6 years. So just 6 years instead of the 24 years in the top chart. As you can see, $1 million invested in the strategic portfolio in March of 2019 grew to $1.53 million as of December 2024, which likely achieved investors' expectations. However, $1 million grew to just $1.22 million for an equal weighted portfolio and to $1.27 million for the dynamic or valuation-driven portfolio. So over the past several years, it's probably been disappointing to be invested in either of the two portfolios that actually performed better over the longer period shown in the top chart. Looking at both charts, our key insight is that any strategy will likely go through periods of out or underperformance, but reversals tend to occur. So again, choosing a strategy that's comfortable and allows an investor to remain fully invested will likely lead to the best outcome. While the previous charts plot the cumulative returns of the three strategies over time, the scatter plots we're about to display on slide 6 plot the annualized returns versus the annualized risk of those three portfolios. Starting with the top chart, the vertical axis plots annualized return. So higher on the chart means more return. The horizontal axis plots annualized volatility. So the further to the left means less risk. The white square box in the middle is the average of a peer group of dozens of funds in which one could have invested. The white box is essentially representing an investor investing in many different funds across many different fund families. So the most desirable location to be on the chart is in the top left quadrant, up and to the left of the white box. That area represents a higher average annualized return with lower average annualized risk than the peer group median. So how did our three portfolios perform over this entire 24-month period? The strategic or cap-weighted portfolio generated an annualized return of 5.4% with annualized risk of 9.9%. So a bit better on both metrics than the peer group median. An equal weighted portfolio did a bit better with an annualized return of 5.8%, albeit with slightly higher risk of 10.9%. And the dynamic portfolio or valuation-driven portfolio did even better with an annualized return of 6.2%, exhibiting annualized risk of 9.4%. Note that all three portfolios were in the top left quadrant, so they all did fairly well relative to the peer group. However, like the previous slide, over shorter periods, the results and investment experience can differ. Moving to the bottom chart, the strategic or cap-weighted portfolio clearly won from a risk-return perspective. In fact, as you look at the data points on the screen, it is the only portfolio, the strategic portfolio, that is in the top left quadrant over the past several years. So the analysis shared on slide 5, owning an equal weighted portfolio or a dynamic portfolio, has likely been frustrating, and that's confirmed by this chart as well. With that said, both of those portfolios outperform the strategic portfolio over the longer term, as you can see in the top chart on both of those two slides. Okay, with that, let me turn it over to Marc to do a deeper dive on some of the reasons why these portfolio results that we just walked through have varied so dramatically over longer and shorter periods of time.
Thanks, John. Investors often use history, and specifically historical patterns, to help guide decisions. And while the future does not always mirror the past, most often it does bear a close resemblance, especially when viewed over long arcs of time. Unfortunately, history has not been as useful of a guide for making decisions in financial markets over the last several years. And the charts on 7 and 8 will bring that to light. Starting with the top chart on slide 7, we show the relative performance of the S&P 500 against European equities. S&P 500 outperformance is marked by periods with the blue line, and European equities outperformance is indicated by periods with the orange line. In general, periods of outperformance extend around 6 years on average and peak around 80 to 85% on a cumulative basis, with movements or outperformance in both directions. This pattern for about the first 40 years in the chart leads to total relative outperformance of 0.9 for roughly no net gain, meaning the S&P 500 and European equities generated comparable returns. This holds true except for the period starting after the global financial crisis in 2009 and at the far right of the chart. That blue line runs uninterrupted for 17 years versus the average for other periods of 6 years, and marks a period when the S&P 500 outperformed European equities by 261% versus an average of 70% for the other periods. So both the duration and the size of the S&P 500 outperformance in recent years are well beyond anything we've observed in the past 50 years. In the bottom chart on slide 7, we compare the relative performance of the S&P 500, again in the blue, against fixed income, and specifically the Barclays Bloomberg US Aggregate Bond Index in the orange. This chart is similar to the one on top, although with more abbreviated periods of outperformance, that peak in this data series at about 100%, followed by reversals of similar magnitude. Again, the outlier is the post-2008 period, when the S&P 500 has cumulatively outperformed the US Ag by over 200% and more than double any prior precedent, and done so over a stretch of almost 16 years, or more than 4 times the average of prior cycles. So having reviewed past relationships within an asset class, that is global equities, and across asset classes, US stocks versus fixed income, the next chart is focused on currencies and the US dollar against a trade-weighted basket of major currencies. Again, we observe periods of dollar appreciation in the blue and dollar weakness in the orange. Currency cycles generally run 6 to 10 years and crest with cumulative moves around 40 to 50%, either up or down, with the latest sequence in the time series on the far right, again indicating a departure from other periods, with the dollar appreciating by 72% and over an extended length of time. Yes, there is some overlap between the S&P 500 outperformance and the dollar chart, as it should not be surprising that US equities generally do better when the US economy is doing well on a relative basis, and that draws in foreign capital and leads to dollar strengthening. But that relationship is not perfect. For example, the dollar weakened from 1985 to 1995, and over that stretch of time, you had both European and S&P 500 outperformance. Nevertheless, the overall point is that this market cycle across multiple dimensions looks stretched. And that's not to say the cycle can't run further, but history would suggest the observed trends are more likely to reverse than to persist over the next several years. With that, let me turn it back to John to discuss US technology stocks in the emergence of artificial intelligence.
Thanks, Mark. The charts that we're about to present on slide 9 shed more light on the performance differences of the 3 globally diversified portfolios we reviewed a few moments ago on slides 5 and 6. The charts zoom in on the 13 companies we consider big tech. Although these companies represent a small number of the total companies in the S&P 500, they have represented a growing portion of the market's total capitalization. Big tech's high and growing margins have led to high and growing valuations, but the composition of big tech can undergo abrupt changes as competition, innovation, and consumer priorities shift. The top chart illustrates the point. In the mid-1990s, a handful of companies shaded in blue, Oracle, Intel, IBM, Cisco, and eBay, represented approximately 68% of big tech's market capitalization. Today, those same companies only represent 5%. You can see that shift starting on the left-hand side of the chart, with a large portion represented by the blue companies, and then moving to the right with a relatively small portion still represented by those same companies. Over the years, the blue companies lost their leadership positions to the rise of social media, online advertising, smartphones, consumer services, and more recently, advances in artificial intelligence. The companies shaded in orange, which include NVIDIA, Google, Netflix, Amazon, Apple, and Facebook. You can see that as the orange companies grow, moving from the left to the right. Although each of the companies shaded in blue has survived, they have done so with much more modest expectations and valuations than they had exhibited in the past. Whereas their combined market cap was $1.5 trillion in August of 2000, today they represent just $1.0 trillion, losing a combined $467 billion in value over the past 24 years. And that seems like a heck of a long time to us to lose about a third of your money. Clearly, competition and new innovations can shake up industry leadership over time, and the leaders of today may well turn out to be the laggards of tomorrow. This result makes it difficult to know in advance which companies will win over the long term. And it's this dynamic, along with the ones Marc just discussed, that largely caused the performance differences among the globally diversified portfolios we reviewed on slides 5 and 6. An interesting exception to the rise and fall of industry leadership is Microsoft, which we refer to as the big tech bellwether, at least so far. Shown in green, it has successfully supplemented its core businesses, operating systems and software applications, with growth businesses, gaming, entertainment, and cloud services, though it has just missed its cloud services revenue expectations with some softening around Azure. But as a result, Microsoft is the only company that's been able to successfully navigate through pivots in consumer tastes and disruptions from new technologies. Today, Microsoft is nearly tied with Apple as the most valuable company in the S&P 500 with a total market cap of roughly $3.1 trillion. The bottom chart shows how quickly the concentration in market cap can change. For example, just prior to the TMT, Technology, Media, Telecommunication event, the big tech companies represented approximately 14% or $1.9 trillion of the S&P 500. Just after the TMT, that same group of stocks represented just 7% or $558 billion. Today, they represent a whopping 37% or $18.4 trillion. In addition, the companies appear highly correlated, meaning they tend to ebb and flow together. As a result, they offer little portfolio diversification and therefore give rise to amplified outcomes as they advance or decline. With and across big tech, the pace of advances in artificial intelligence has been accelerating. The chart on slide 10 allows us to compare various advances in AI relative to human-level performance. The dashed gray line is the human baseline, with any performance above that horizontal line representing advances in AI that exceed human capabilities, and any performance below that line representing advances that have not yet achieved human-level capabilities. For example, starting in 2012, AI advances included image classification, illustrated by the black line, which followed many years of slow but continuous progress in handwriting and speech recognition. As you can see, image classification started at about 89% of human-level capabilities in 2012, achieving human-level capabilities a few years later in 2015, and somewhat exceeding humans since then. The two green lines show two advances in visual reasoning, each of which were initially below human-level achievement, but narrowed the gaps over about 5-year periods. Next, we show 5 blue lines for various advances in language reasoning. As you can see, some of the blue lines started out even further below human-level benchmarks, but they quickly made up the distance in just 2 to 4 years. But perhaps the most remarkable are the advances artificial intelligence has made when it comes to mathematics, which probably many of us would agree is about as different of a language as you can get, although it's a universal one. The orange line shows AI systems nearly reaching human-level proficiency in competitive math over just a 2-year period. although they started out in the deepest hole. In fact, in 2021, AI systems were only correctly answering about 6 to 7% of competition-level math questions and failed to consistently grasp basic relationships. For example, they would frequently make geometric mistakes when calculating the sizes of various shapes. But after a couple of years, the accuracy of AI-based math programs improved to around 90%, with the potential of making further gains and leaps going forward. Overall, and most importantly, the level of difficulty of these various tasks became more and more challenging, and it took less and less time for the AI systems to reach human-level proficiency. In other words, the pace of progress of the AI programs accelerated at an even faster pace than the difficulty of the tasks themselves. The hope of realizing the potential of these immense benefits from these advances, namely in worker productivity and capital efficiency, has caused many companies to view AI as an existential threat to their business models. They're either going to help develop and leverage AI, or they're going to lose out, like the blue companies we highlighted on slide 9. And at the moment, they have the resources to invest heavily. The top chart on slide 11 plots corporate cash balances since 2010. Cash balances, both for individuals and for companies, ballooned during the pandemic from 2020 to 2022, rising from roughly $4.5 trillion to $6.5 trillion, or an increase of 44% over that period. And no surprise, cash doesn't tend to sit idly on corporate balance sheets for very long because most executives prefer to spend it. Routinely, excess cash is used to fund a range of corporate activities, from share buybacks and increased dividends to mergers and acquisitions, all of which tend to support equity prices. But companies also invest their cash in capital expenditures and research and development, especially when an AI arms race is underway. CapEx, the orange line in the bottom chart, has more than doubled since 2010 and is up about 40% since 2021. Research and development, the blue line in the bottom chart, has shown an even more dramatic increase, more than quadrupling since 2010 and up 60% in the last few years. The increases in both CapEx and R&D can be linked to the rapidly increasing investments in artificial intelligence. To illustrate the point, just among Amazon, Alphabet, Microsoft, Meta, those 4 companies alone account for roughly 23% of the total US CapEx. 10 years ago, those same 4 companies accounted for just 3% of total US CapEx. How these investments in AI pan out, whether good or bad, won't be known for at least a few years. But we certainly don't expect every dollar spent to have been worthwhile, and therefore investors will be on their toes, quickly assessing and reassessing the impact to company valuations. For example, as Jan mentioned earlier, and as you may have read, DeepSeek, a Chinese AI company, recently introduced an AI model capturing global attention. The company claims its AI model, known as R1, uses less advanced chips and less energy, and therefore is achieving similar testing results as ChatGPT and other leading AI systems, but at significantly lower costs. If true, it would mean that DeepSeek's US competitors have wasted and are currently wasting billions of dollars buying and using more complex and expensive chips and energy from NVIDIA that don't actually make a difference in the development of AI programs. While it'll take some time to fully assess DeepSeek's impact on the growth and earnings of other AI-related companies, as Jan mentioned in her opening comments, investors were swift to dramatically reduce their expectations for NVIDIA. In fact, the stock lost $600 billion of market capitalization on Monday alone, making the largest decline in any publicly traded company in any single day ever. With that said, the stock's value is still roughly twice what it was a year or so ago, so expectations are still incredibly high. Importantly, we believe that competition across companies, including those engaged in AI, is ultimately beneficial to consumers, leading to better quality and lower cost for most products and services. So we expect advances in AI to improve our standards of living over time, but some companies will win and others will lose. All right, with that, let me turn it back over to Marc to zoom out now on what we're seeing for economic growth and equity valuations, including within the context of today's environment compared to the past several years.
Thanks, John. Slide 12 is another way to portray the remarkable run in U.S. equities by comparing regional market cap to regional GDP. The top chart on slide 12 begins with regional GDP. The US in the orange line and Europe, including the United Kingdom in the blue line, have consistently been the two largest economic zones in the world over the past 45 years. Each represents about 25 to 30% of world GDP. The emergence of China, the dark gray line, in the last decades is the big change in global output, rising from 3% to just below 17% today. Most of that gain came at the expense of Japan, represented by the light gray line. Japan peaked as a percent of global GDP in the early 1990s at 18%, and today stands at just 4%. Across the four main economic zones, the US, Europe, China, and Japan, most regions or countries' market cap falls short of its GDP. For example, Europe's market cap is less than 40% of its GDP, and China's is about 17% of its GDP. Japanese market capitalization is slightly above its GDP, but it's a considerably smaller economic zone, roughly 1/4 the size of the Chinese economy and 1/6 the size of the US. The US market cap of 62 trillion is more than double the US GDP of 29 trillion, and now accounts for two-thirds of world market cap, and is depicted in the orange line in the bottom chart of slide 12. This concentration of global market cap in the US is the highest in several decades, and up more than 20 points since 2010. Now let's turn to the political landscape and some observations following the elections in November. With former President Trump's successful return to office, together with Republican majorities in both the Senate and the House, Republicans now have unified control of the federal government and look eager to use that power to advance their agenda. Well, only 10 days into the administration, the Trump team has started to impose a number of reforms to existing regulations and domestic and foreign policies, specifically around energy, trade, and immigration. Now, it's going to take some time to fully grasp the reach and impact of these shifts, but we do know that the second Trump administration may be constrained in ways that are much different than the start of his first term. The most obvious difference between now and then is inflation remains above target, and current interest rates along the curve, as well as mortgage rates, are well above pre-pandemic levels. So any pro-growth policies pursued by the Trump administration must be carefully calibrated so they don't reignite inflation and prompt a tightening of financial conditions. Now, this is especially relevant when real economic growth is at or around productive capacity and labor markets are generally healthy. The labor force participation rate is at a multi-decade high, and unemployment is low by historical measures. Yes, unemployment has inched higher from a low of 3.4%, but we don't have much slack in the labor market, especially when you consider the vast majority of the population growth, greater than 80% in recent years, has come from net immigration, an outcome that is almost certain to fall over the coming months. Another constraint on Trump 2.0 is the fiscal position of the federal government. Today, interest costs alone sum to more than $1 trillion, or $600 billion more than in 2016. And he inherits a federal budget deficit of more than 6.5% of GDP, or double the level in 2016. New tax cuts, and possibly just extending the provisions of the Tax Cuts and Jobs Act of 2017 that sunset at the end of the year, will force spending reductions and/or the opening of new revenue streams. And these actions must be done without upending economic behaviors and growth. Remember, the government spends about $6.75 trillion, at least for this fiscal year. Mandatory spending on things like Social Security, Medicare, other entitlements, and interest account for about 2/3 to 70% of that spending. Defense spending adds another 9 or 10%. So you're close to 80% of the budget already spoken for. So Elon Musk and the Department of Government Efficiency have a difficult task ahead of them to create space for some of the policy initiatives President Trump promoted on the campaign. And since we know President Trump looks at the equity markets as a real-time scorecard for his presidency, we finished the comparisons with the S&P 500 on the bottom of the table of slide 13. The S&P 500 is up nearly 200% since his first victory in 2016. About half of that gain is from the doubling of earnings, with a balance from a rise in valuations. The S&P 500 now trades at 27 times trailing earnings and 25 times forward earnings, both well above levels in 2016 and historical averages, suggesting the gains going forward will be a bit harder to come by versus 8 years ago. I'll close with slide 14. We've largely settled into a post-pandemic economy with many of the policy and supply dislocations behind us. Inflation is among the few exceptions, but moving stubbornly towards target. Unemployment is at 4.1%. Real U.S. GDP is growing around 2.5% to 3%, and doing so primarily on the strength of consumer spending. Unlike prior economic cycles, the growth in consumer spending, which is about 70% of the economy, has been funded largely from growing incomes in recent months and has been less sensitive to changes in the cost of credit. And worker productivity has finally rebounded sharply in the last couple of years. Now, this aggregate data, however, masks some potential risks and warning signs, especially among the more vulnerable, lower income cohorts of the economy that have been squeezed the hardest by years of inflation. Rising credit card and auto loan delinquencies are some consequences of that struggle. We are also seeing an increase in corporate bankruptcies as floating rate loans and higher funding costs are pressuring margins and cash flows. Geopolitical risk with flashpoints in multiple regions of the world are as high as they've been in the last 30 years. And domestically, our politics remain deeply partisan amid growing fiscal imbalances. As discussed earlier, U.S. equity and dollar outperformance has persisted longer and in scale well beyond any period in the past 50 years. Given that assortment of risks facing investors, diversification within and across asset classes seems particularly well advised to help navigate through the months and years to come. So with that, I'll turn it back to Jan and Laura for any final comments or questions.
Thank you, Mark. Before we dive into the questions we've already received, I'd like to take a moment to remind everyone that if you still have questions, please feel free to submit them through the Q&A box on your screen. We'll do our best to address as many as we can. Let's start with a question about interest rate expectations. You mentioned that yesterday Fed decided to hold target interest rate at 4.5%. Do you expect interest rates to come down in the future? If so, when and by how much?
I think the market's expecting to get to longer term interest rates of 3.25, so low threes over the next couple of years. And that's fairly consistent with what's called the Fed dot plot or the FOMC dot plot. So we don't really have a point of view that's dramatically different than that. So from 4.5 to low threes or 3 over the next couple of years. So you'd expect to see quarter point, half point moves, but it is very clear from both the Fed's actions yesterday as well as just the comments around not taking or reducing rates more, that they are going to closely monitor inflation, levels of growth, levels of employment, and how Trump's policies and the support of those policies are affecting those same things: inflation rates, employment, geometric, economic growth, and so on.
Yeah, to John's point, I think in the absence of any policy shifts, I think we would see rates coming down. But to Paul's comments, I think the big uncertainty is how does policy change in the months and years ahead, given the new administration and some of the shifts that they're forecasting or previewing are pretty different than where we've been. So I think we'll be on pause until there's more visibility around that.
On the topic of interest rates, what are your thoughts about Fed Chairman Powell's future within the new administration and any concerns?
I mean, I'll jump in on that one. I think that's a tough dynamic. Powell wants to run, and rightfully so, an independent Fed. But Trump wants to influence all corners of government, DOJ, FBI, and the Fed. He's in favor of lower rates. So I view that as a collision that's going to occur. It's just a matter of when. So we'll see. But I think there's definitely going to be tension between those two, Powell and Trump.
Yeah, Powell was asked that same question or similar question. So the question from our clients is similar to one that was asked of him yesterday. And he basically said he's not going to talk about it. The Fed is supposed to be an independent body. He's not going to address it. It'd be inappropriate for a Fed member to address a sitting president's views of policy, interest rate policies. With that said, I think his current term comes up. Powell's current term comes up in May of 26. So it's just a year and a few months from now. So he may have to withstand some badgering from President Trump in the public view, but unlikely to influence any decisions that they take. And then Trump will have the option of appointing a different Fed chair in 15 or so months.
Moving away from interest rates, considering the increase in small cap value mutual funds over the past year or so, is small cap value still considered to be a good investment?
I mean, we like small cap just as a durable exposure, and we like value as a durable exposure. And so the combination of both of those, is an area that we, think should be in investor portfolios over the long term. And that's whether it's a strategic portfolio, and in that case, you would hold some kind of strategic allocation, or in a dynamic portfolio where you might be changing the sizing of small cap and small cap value versus small cap growth. But yeah, our views about small cap and US small cap relative to large cap in the US are still favorable. We're still leaning in. We think that if the economy in nominal terms, so some of the Trump policies will certainly be inflationary relative to expectations 6 or so months ago. But US small cap firms should benefit from that. And they should also benefit to some degree from friendshoring and nearshoring and things of that sort that are also part of the Trump international foreign policy that are currently, underway.
What catalysts or signals are you looking for to make decisions around changing from the current weight and growth stocks versus, to more value weighted stock?
Yeah, so we durably own US large cap growth stocks, but over the years we've owned them through what we call quality implementation. So those are companies that have high ROE, return on equity, stable ROE, and they do those two things with low debt, and they tend to have moats around their business models. So we've owned a segment of quality stocks, which are generally lean towards US growth stocks, but they're the ones that are less expensive. That's the way to think about it, than the very expensive part of US large cap growth. In terms of what it would take for us to own more, geez, we'd like to see a pullback like we saw in NVIDIA. That's the kind of experience you could expect, a minus 15% in a week in NVIDIA, and potentially further pullback or not. We're not making a call on NVIDIA. But if we saw bigger pullbacks in US large cap growth stocks and even outside of the US, we would certainly invest through our dynamic portfolios. We'd rotate into those. In our strategic portfolios, we just own the market. What the market owns, we roughly own in the strategic portfolios.
Slowing economic growth might be another trigger. Value stocks tend to be more cyclical. So if you do have an economic slowdown and growth is 1.5% or less, that might be another opportunity to rotate more into the cheaper quality stocks, because that's an environment where, you know, those stocks are going to grow much faster than the overall market, and investors will pay up for that in that type of environment. So that could be another trigger or something to look for.
With bond yields at the levels that they are now, does the role of diversifiers diminish in portfolios?
So we mentioned diversifiers a couple of times today, and we mentioned them in our dynamic portfolios. They play a role. So as a reminder for those of you that may not hold diversifiers, they tend to be strategies that aren't highly correlated with either equities or bonds. So they tend to be a bit agnostic to either of those two exposures. When they particularly do well is when interest rates are, so they're cash plus strategies. You're trying to generate cash plus a premium. Our implementation has roughly achieved our objectives over the past several years. So yes, as bond yields are higher, the premium for something greater than that isn't as attractive. It's one of the reasons that we've added a bit to fixed income in our dynamic portfolios and reduced our diversifiers. But the other part of diversifiers is spreads of opportunities. So one of the questions that Jan just asked was on US small cap stocks or value stocks, and another was on growth. So as we see spread opportunities, or the managers that we invest in, growth looks really attractive, or value does, US looks really attractive, or international does, that creates another part of the opportunity set we're trying to capture. So while one of the reasons for holding diversifiers, fixed income, looks relatively more attractive today than it did in the past, is true, the other, the spread of opportunities, still exists. And so we expect many of the managers in our diversifier lineup to continue to perform well going forward. And it's obviously outperformed fixed income historically and underperformed equities, but we'd expect something like that going forward as well. You know, doing well relative to both asset classes or a blend.
So AI seems to be a big wild card. What are your thoughts on the best way to invest in it?
So we've talked about portfolio diversification. That's certainly a key component. The quality companies that we own, some of those are Microsoft, Google, Apple, and so on. Those are some of the companies that are involved in the AI arms race. So our clients currently have exposure to the companies that are rapidly developing and leveraging AI, and those that are actually selling the chips and so on associated with AI. Much like the internet, the benefits just accrued to to lots of companies, both publicly traded and privately held. We're expecting to hold that. We just don't focus any area of the portfolio on a new or developing technology. We haven't done that with AI. We haven't done that with cryptocurrencies as another example. We prefer to have a more broadly diversified portfolios, and over time, not pick the winners or the losers in any particular segment, as we talked about the blue and the orange companies earlier, and instead own the entire part of the segment and those that are a little cheaper.
Yeah, just to tag along on that, obviously the easiest way to benefit from AI is just owning a handful of those tech leaders. Derivative of that we've seen from some of our managers is to hold energy producers, because that feeds into the data centers that will breathe life into the AI models. So that's one way to do it. Another thing just emerging in the last week is just to own some of the, if you're comfortable owning Chinese stocks, is just some of the Chinese tech platforms as they look to build their own AI models. And those companies are dramatically cheaper than the US. So just, I mean, we're not really stock pickers, but just to answer the question, just for curiosity, those are some things that come to mind.
Maybe we could go back to where we ended on, some of Trump's foreign policies. What do you think in terms of how could they result in a tariff war or a trade war?
Certainly. I don't think, I mean, even Canada is probably one, if not our most friendly neighbor, is already assembled some response if he does impose tariffs on China. So I think that's almost a certainty. China's not going to stand still. And obviously, things like this are why the Fed is waiting to see how it's going to, deal with rates over the course of the year. I mean, the global supply chain was modeled around efficiencies, so going to the lowest cost countries and manufacturers. So if we're moving away from that, which obviously seems to be the case, and tariffs will raise the cost of doing business, price levels are going to have a step up. How durable that is or how significant it is to be determined. But if we start imposing, whether it's directly with countries or a universal tariff, which he's also talked about, he was talking about that yesterday, there's definitely going to be a response across the globe.
Yeah, it's one of the, I don't have much to add to what Mark said. How tariffs, it's a tax, right? Ultimately, it's a tax that consumers pay because your price of inputs goes up. But if you're achieving other political objectives, you're okay with that additional cost over time. But there will be countries that win and countries that lose. Importantly, on the immigration issue, immigration, as we've talked about before, just your labor force, the size of your labor force is a key input to how fast your economy is growing. And historically, the US has imported talent. When it comes to, illegal immigration or people that are undesirable or have, malintentions to be in the US, we can understand why, some of the policies and views have changed around that area. But broad immigration and the benefits from it should not be muddled with a few evildoers that come into the country, or thousands, but a small portion of the overall immigration that comes into the US to find better lives, to work hard, to grow the economy, and that benefits all of us. The interesting thing about AI and the reason that we showed the chart with the advances is you can also gain productivity from your existing workforce. And AI, just like the internet, just like supply chain management, just like enterprise resource planning systems in the 1990s, all of those massive advances in technology helped with the US's productivity relative to other countries. And so if we're going to have a slower growth population, in part due to birth rates that have been dropping in the US and more broadly, in part due to immigration, maybe some of that will be offset with efficiencies and productivity coming from AI.
Which asset classes tend to perform well in environments with tariffs and rising inflation?
You want to take
Yeah,
that?
I would. Yeah, just hard assets. So think, even real estate. I think that's one area. Obviously, real estate's had a tough go of it the last couple of years, but Trump's a real estate guy, so it might be a different day for real estate. And obviously, return to office for federal workers. More companies are doing that. That should help the office landlords. So that's one area. Commodities, tips. Those are some things that generally do well in inflationary environments.
And so what opportunities do you see emerging from the new administration's policy priorities?
I think maybe the most obvious is around energy, and it's not just traditional energy, fossil fuel energy, just because, he's going to allow more drilling on federal lands. He's going to ease the permitting process for liquid natural gas. All that should help from a production standpoint. But we need all sources of energy. So I think one area that probably gets overlooked is just renewables have taken a hit because his posture is very different than Biden, and Biden obviously helped get the Inflation Reduction Act, which is really a renewable energy piece of legislation more than anything else. But those companies in that complex have probably gotten hit pretty hard. So I would look for a bottoming there at some point as a contrarian play, because to support data centers and other things, everything's being electrified. EVs, I know they're moving away from EVs in terms of supporting that, but everywhere else in the world is moving in that direction. So the more obvious is traditional fossil fuels, but I think at some point renewables and things centered around that, just because the prices have gotten hit so hard, might be worth looking into.
Yeah, and just to add to that, just thinking about inflation, and the impact of tariffs, it's, there's sort of the things that you want to lean into are things that are necessities. Marc touched on some of those. So energy being one of those, but other necessities like real estate, your homes, office space, and so on. There are things where the companies can pass on pricing or inflationary increases to their customers. So, whether that's in social media or technology, pharmaceuticals, and so on. And then there are things of limited quantity or limited supply. So that's a whole nother set of commodities, real assets that Marc talked about as well. But those are sort of the three umbrellas where you'd want to lean into different opportunities in a more tariff-oriented, higher inflationary environment.
And what about cryptocurrencies, especially given Trump's support?
That question must have come in when I said we don't really. So the challenge with cryptocurrencies, we've talked about it a bit in, now we have a Melania coin and a Trump coin, but we've talked about it in previous webinars. If you're going to try to find something to hedge the real dollar value or real economic value of your portfolio, gold to us seems like a better choice. It's been around for 3,000 years. It was used as the primary currency around the planet for many years. It doesn't have the same volatility as any of the cryptocurrencies or most of the cryptocurrencies. So it's sort of a more known hedge on the value of a portfolio versus cryptocurrencies, which we've talked about in the past. You literally can just start a new cryptocurrency on a daily basis. There's an ad infinitum supply or potential supply, though there are some leading cryptocurrencies. I mean, one of the best examples is MicroStrategy, publicly traded company, which I think in November, the CEO came out on CNBC or somewhere and said that fundamentally the business, which only buys Bitcoin, is in the business of selling $1 bills for $3 bills, because the market cap of MicroStrategy was 3 times what the value of the Bitcoin that they actually own. So it's just an example of the speculation in the area. It's really hard for us to speculate with our clients' money that they work so hard for. But we know that people have made and lost millions and tens of millions in cryptocurrencies. Sorry, Marc, you might
Just a couple of things to add. Like, you can make an argument there's no more powerful government institution than the Federal Reserve. And the Federal Reserve prosecutes monetary policy by controlling the money supply and the price of money. So why would it allow itself to be disintermediated by a cryptocurrency and deferring to some other entity to set the level of money in the economy? It just doesn't make any sense. If crypto got widely adopted, you would assume the Fed would step in to try to thwart any further adoption. And then the other thing, the dollar is the world's reserve currency. Some of that is because there's no great alternative among fiat currencies. So, and with that comes a lot of advantages. We wouldn't be able to fund our deficits at the levels that we're able to if we weren't a reserve currency. So a little puzzling why Trump would embrace things that would kind of erode the dollar's position as the world's reserve currency. So again, I can see some merits between maybe a stable coin, which is backed by dollars, or a central bank digital currency, but Bitcoin and others are a bit of a puzzle.
All right, thank you, everyone. It looks like we have reached the end of our webinar, so we want to be mindful of your time. We truly appreciate your participation and thank you for sharing your thoughtful questions with us. If we didn't get to your question, please rest assured the Aspiriant team will be reaching out to you directly in the coming days. In conclusion, while we remain optimistic about the opportunities ahead, we understand that investing can feel unsettling during the times of ongoing political, economic, and geopolitical changes, along with new policies and market fluctuations. We hope that today's discussion has provided you confidence in the research we conduct and the insights we gain as we manage your portfolios in balanced and disciplined manner. We deeply appreciate your trust and partnership as we continue to navigate continuously evolving global economic and political landscape. As always, your client service team is here to discuss any thoughts you have about the markets or your portfolio. So please don't hesitate to reach out at any time. Thank you again for your time. We look forward to having you join us for our upcoming webinars. Be well and enjoy the rest of your day.
Bye-bye.
Thanks, everyone.